On board, Shreyash Devalkar, head of equity at Axis Mutual Fund, joining in on the show right now to talk about where he feels the market is headed next. Shreyash, hi, great to have you on the show. Shreyash, done with earnings. What do you think the market is going to be working with in terms of a trigger?
Hi, good morning, and thanks for inviting on your show. Actually, after this result season, and everyone has observed that the result season was broadly positive versus expectation. Though there are certain concerns over margins, but generally it's expected that the margins may improve in the coming quarters. The top line growth was really good. So starting now from here on, generally what happens is you are actually entering a festive season in India. So in that context, when you look at if you look at the consumption part of the economy, then one may observe that the inventory built up and channel filling, which may happen during these times. So that part and the festive season ahead is what would drive on the consumption part of the economy, and what is the outlook. Especially the larger chunk is from categories like autos, where it is actually considered as a key pillar for the consumer discretionary spend. So that part one should look at closely. The high frequency indicators which are getting disclosed every month end, that one should observe on one part. When it comes to the investment part of economy, there you are observing that there are multiple positive developments, especially in the manufacturing part. So when I say manufacturing, it is right from capital goods to auto ancillaries to electronic manufacturing services. So here, multiple companies actually are announcing good order book as well as order inflow during these times. One more observation is there is a change in the supply chain. There is a move towards spend because of data center outlay, and that is helping multiple industries. So earlier we thought that it will only affect few industries at the on the technology higher end of the technology end. But now, because of the capacity constraint worldwide, multiple industries are benefiting on the manufacturing side. So one should observe on that count as well. In India, again, because of various policy measures, the electronic manufacturing services is also doing well. So that is one part. The bigger part of the market, always, especially in the large cap, has been the financial services and FMCG. These two packs are yet not showing those signs, in which actually FMCG volume growth has not been that great, and that uptick one may have to wait for some more time. But when it comes to the banking and financial services part of the economy, here at least the credit growth is actually inching up month after month, fortnight after fortnight when you look at the data points. Whatever commentary has been so far by the banks on the credit quality also is good. So one should look forward to this. How is the interest rate outlook that will shape up the performances of the bank? Because all of us know that the NIMs are not as great as expected. Any signs of uptick in the interest rate may lead to the good part of the earnings in banks as well.
Shreyash, hi, this is Harshya. I wonder how you're looking at the auto pack, because you've got a decent kind of allocation now within auto. Are you by any chance trimming the portfolio at all? Am I getting this right?
See, in auto, one should observe it in more details. The portfolio is part of it. So there are auto OEMs and there are auto ancillaries. As far as auto OEMs are concerned, you are observing that there is a growth driven by new product launches, as well as new model launches, as well as the EV penetration. So we are actually more tilted towards that part of auto OEM, which are more driven by the new model launches, as well as EV penetration and the beneficiary of that, and whoever has that EV model cycle right in this cycle. So this is the auto OEM part of it. When you look at auto ancillary part of it, and that's where I tried to explain that auto ancillary is no more Indian auto OEM dependent auto ancillary. So today's auto ancillary, especially if you see multiple companies in this pack, they are beneficiary of exports. They are beneficiary of their incremental presence in electronic manufacturing services, the physical AI, because of which the requirement of multiple components for the robots, etc. There again, the same auto ancillary is actually going to benefit whoever is ready for that, obviously. So that part is also one of the angle in auto ancillary. Auto ancillaries, there are multiple companies which are actually tying up with multiple global industries or global leaders to have presence in India. So auto ancillaries are actually offering multiple option value as such by trying to expand in the manufacturing landscape of India. And that's how we are looking at auto space as such.
Interesting. Having said that, Shreyas, I'm quite intrigued to learn that you're underweight power despite calling capex a structural theme. Why is that so?
Generally, at least my observation historically, when it comes to asset owners, so there are beneficiaries of someone spending doing the capex, and then there are asset owners. So since asset owners need to do capex, one need to really focus on the ROEs of the businesses and amount of capital required for the growth. So on these two counts, generally asset owners is what we have always had lesser in our portfolios compared to the beneficiary of the capex as such.
Okay, and Shreyash, very curious to know how you're looking at IT. There are just so many views out there, and heavy opinions.
True, and see, actually for us, IT has been underweight call for longer period of time than just because of AI. Because even irrespective of AI impact, which actually market started talking about in last 1 year more so, before that also the growth was slowing down dramatically. It was actually 5% or lower, especially in the larger companies. Now, with that kind of growth, whether you want to invest or you want to be overweight in a sector, so that was the bigger question actually. And that part was led by multiple macroeconomic factors, geopolitical factors as such, and it was not only about AI. Even today, I don't want to get into whether AI will affect the growth or not. The fact of the matter is there is some disinflationary pressure because of which the growth is in mid-single digit, and in that context, then whenever these companies comes into that value pack or value segment, at that time there always be arguments around fundamentals as well, whether how much AI is affecting and then whether we should buy at this valuation or not. So from that point of view, one may look at, so just to give you a perspective, if a company is growing at 4% dollar term, you add to it 3 to 4% rupee depreciation, then there is a dividend yield of 4%, then it looks good returns as such. But out of these three factors which I spoken about, how many of them you want to assume that they will repeat? You cannot just say that I want to buy because of the rupee depreciation as such. So in this overall context, for us in our portfolio also, you must have seen as of last month end, we are underweight on the sector. If any, because of the valuations comfort, one may look at some company, but on an overall trend basis, if unless the growth trajectory moves above 5% in dollar term, it becomes difficult heavyweight investment.
For staples, Shreyas, is the call underweight given that weak demand is what one is witnessing on ground, and that coupled with, of course, high valuations, which are always a concern for staples?
Actually, staples valuations are contracting a lot. Actually, we did one analysis of which sectors got derated compared to the pre-COVID. So forget about last 2 years, 3 years valuations. If you compare the valuations of the sectors which got derated compared to the pre-COVID, then there is a private sector bank, there is IT, and obviously consumer staples, there actually it is flattish. So it is a 33, 34 P multiple at the sectoral level I'm talking about. Now, this sector on a relative basis has definitely got derated. But here, the volume growth, again, I'm coming back to what argument I had for IT. If the volume growths are not going to be high in this, one may always bet on the price increase. If again that price increase is led by premiumization, then yes, they may fetch higher multiple. But if it is not because of the premiumization, it is just because of the raw material price increase being passed on, then it is not really a great news as such. So from that point of view, the volume growth is where we are focusing on. And if you notice our portfolios again, there is tilt towards food-based FMCG company, because there at least the growth has been higher. And multiple companies have shown appetite to get into newer categories, newer brands, and newer products, and growing because of that.
Shreyash, also curious to know, with regard to healthcare, is it more of a bottom-up story now, that the kind of moves that we've seen in terms of the rally, or is it still very much a secular kind of trend and very much top-down in terms of the structural story?
In terms of healthcare, I'm sure you mean either hospitals as well as pharmaceuticals together.
That's
So
right.
hospitals. Okay. So hospitals, we have been positive again for a longer period of time. In my opinion, it is both top-down story. If you see the beauty of this sector, the way it has emerged in the last 3-4 years, here multiple models have shown success, and that actually shows the strength of the sector on ground. So there are companies which are traditional and they have been there in India for decades. There are companies which actually entered and started corporatizing and growing in last few years. There are companies driven by private equity. There are companies driven by doctor promoters, etc. And you are seeing that the success is really good in most of this. So that actually shows the top-down strength of the sector. Here again, as you are highlighting, that yes, this was discovered some time back. It is not that today we are talking about something new around this. Few observations we have had in this sector in last 2-3 years, that if you again go back pre-COVID, a new hospital, if any company used to open at that time, it used to take much longer time for it to break even. While today it is taking a shorter time, and that's where we're seeing the expansions also faster, catering to the broader market. So this is where the real, in my opinion, crux of the story around healthcare. And we think that valuations are, yes, they are higher because the story is discovered today, but the companies are doing good.
Right, okay. Shreyash, great to have you today on ET Now. Thank you so much for your time and perspective on markets.
Thank you.